welcome to IndusInd Bank Limited Q1 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumant Kathpalia, Managing Director and CEO, IndusInd Bank. Thank you, and over to you, sir.
Good evening, and thank you for joining this call. Let me start with some macro commentary and then go into the bank-specific details. Economic activity gained momentum during the quarter and is visible from various high-frequency indicators such as PMI. Monetary policy pause was extended with CPI inflation easing below 5% level, and liquidity conditions in the banking sector improved over the quarter. Bank credit growth stabilized around 15%, with personal loans category contributing as the main growth area. Deposit growth picked up, helping to bridge the gap with higher credit growth. On the demand side, private consumption and public investments helped support activity. The strong ongoing pickup in the services sector is supporting urban demand, recovery in rural demand, and improving conditions for capital formation would help growth remain reasonably strong. Relatively bright growth prospects, easing inflation, and overall macroeconomic stability has revived foreign investor interest in India, with net inflows in debt and equity surpassing 10 billion in the last quarter. Coming to quarter-specific developments, our focus areas for the quarter were loan growth momentum. We maintained a healthy growth of 22% year-on-year and 4% quarter-on-quarter, driven equally by consumer and corporate business. Our vehicle business maintained a 21% growth. Vehicle-originated loan growth improved to 14% year-on-year. Other retail growth remained strong at 27%. We are thus seeing loan growth momentum across segments. Maintaining deposit traction. Our retail deposit growth as per LCR accelerated to 21% year-on-year versus 19% in the previous quarter. Share of retail deposits improved to 43.4% versus 42.6% in the previous quarter. Our savings account too grew by 6% quarter-on-quarter, reversing the attrition trend for the last few quarters. Overall, we achieved total growth of 15% year-on-year and 3% quarter-on-quarter, driven by granular retail growth. Continued investments in new initiatives. We continue to invest in our franchise, both in physical as well as digital distribution, scaling our presence in new products and customer segments. Our affluent deposits grew to 44,400 crores, up 22% year-on-year. NRI deposit grew to 37,200 crores, up 39% year-on-year. Loan book under merchant acquiring business via Bharat Financial grew 89% year-on-year to 4,229 crores. Our home loans pilot has reached 665 crores. We have soft launched our digital platform Indi and open for public access. We have hired around 12,600 employees in our distribution over the last 4 quarters. This is all reflected in the OPEX growth of 24% year-on-year and 6% quarter-on-quarter. Improving asset quality. Our gross slippages reduced from rupees 1,603 crores to 1,376 crores quarter-on-quarter. That is from 0.59% to 0.4% of loans quarter-on-quarter. Our restructured book too reduced by 475 crores from 0.84% to 0.66% quarter-on-quarter. Our net NPA is at 0.58%, with provision coverage ratio stable at 71%. Our contingent provisions are at 1,700 crores, with total loan-related provisions at 121% of gross NPAs. Our credit cost has reduced to 33 basis points from 36 basis points quarter-on-quarter. Sustaining profitability of the franchise. Our net interest margins improved by 1 basis point quarter-on-quarter and 8 basis points year-on-year to 4.29% with effective balance sheet management. Client fee income grew by 19% year-on-year, driven by strong continued retail momentum. Our PPOP margin to loans for the quarter was at 5.5% versus 5.6% quarter-on-quarter. Steady improvement in return ratios. Our profit after tax grew by 4% quarter-on-quarter and 30% year-on-year to 2,124 crores. Our return on assets was at 1.90% and return on equity was at 15.24% for quarter one. Our capital adequacy ratio remains healthy with CET1 of 16.44% and overall CRAR at 18.40%. Now coming to individual business. Vehicle finance. The vehicle finance business maintained healthy loan growth of 21% year-on-year and disbursement growth of 18% year-on-year. The segments showing strong disbursements were commercial vehicles, utility vehicles, cars. Disbursements were muted in tractors and two-wheeler segments. The bank has maintained or improved its market share across all vehicle categories. We have also implemented Salesforce loan originating system across all our locations for cars and two-wheelers. This should further improve our efficiency and bring down turnaround time for these segments. Historically, first quarter has been a seasonally weak quarter, whereas quarter four is a seasonally stronger quarter. The second half of the year contributes larger share of disbursements as well as recovery. And we expect that trend to continue this year too. The gross slippage in vehicle improved to 0.77% from versus 1.11% year-on-year, whereas higher than 0.61% quarter-on-quarter due to seasonally weak quarter versus quarter four. The slippages are expected to come down as the year progresses. The restructured book in vehicle finance also reduced from 1,475 crores to 1,182 crores quarter-on-quarter. The collection efficiency of these customers remain comfortable, with bulk of the reduction happening through upgrades and recoveries. The vehicle portfolio has now shown strong disbursements for 2 years. This also reflects into increased share of new loans and repayments drag coming down steadily. The loan growth thus should now move broadly in line or ahead of the disbursement growth. The asset quality should improve from there with seasonality benefits coming in the rest of the year. Bharat Financial Inclusion Limited. The year-on-year growth in microfinance and merchant acquiring book accelerated to 14% versus 11% in the previous quarter. The share of non-microfinance book increased from 7% to 12% year-on-year. The Bharat Financial Inclusion consists of three key segments of microfinance, Bharat Super Shop and Bharat Money Store models. And I will update on all the three segments. Microfinance. We had disbursements of 8,406 crores during this quarter, registering a growth of 12% YOY. Our new-to-bank disbursements are up 19% year-on-year in terms of number of borrowers. Historically, quarter one is a seasonally weaker versus quarter four and reflected in quarter-on-quarter reduction in disbursements. MFI book at the end of quarter one was 31,981 crores, up 9% year-on-year. Active borrower base of about 78 lakh microfinance borrowers, up by 5%. New customers added during the quarter one were around 5,04,000 customers. MFI standard book net collection efficiency for quarter one was at 99.2%. Bharat Super Shop, that is the merchant acquiring business. With strong demand and large pockets of growth available, we continue to expand our merchant acquiring business under the banner of Bharat Super Shop. Portfolio sourced through Bharat Financial under this business has grown to 4,229 crores, up 89% year-on-year and 5% quarter-on-quarter with 660,000 active borrowers. The total disbursement during this quarter was 1,522 crores. The book continues to report healthy growth along with strong asset quality. Our standard book net collection efficiency from this book during quarter one financial year 24 was 99.2%. Bharat Money Store, the Kirana Shop model. We have around 115,000 active Bharat Money stores providing banking at the doorstep in remote areas. Liability book sourced from customers and service to Bharat Financial increased by 44% year-on-year to reach 2,108 crores and through 1.545 crore accounts. Our focus remains to be the banker of choice for our customer segment in Bharat. Overall, on the asset quality side, MFI gross slippages during the quarter reduced to 369 crores as compared to 599 crores in quarter 4 financial year 23. We're adding emphasis on recovery with recovery of 52 crores from NPAs and 32 crores from ARC return of accounts during the quarter. The BFIL standard 30 DPD book remains stable at 1.1% of loans. We expect disbursements from microfinance to pick up as we progress the year. We continue to work on the diversification initiatives and becoming a micro banker from a microfinancer. The asset quality has improved this quarter, and we expect the trends to continue in the rest of the year as well. Corporate Bank. Our corporate loan book maintained healthy growth trajectory of 4% quarter-on-quarter growth. The overall growth continues to be led by growth in small corporates, with small corporates growing by 10% quarter-on-quarter. Within small corporates, our focus strategy on corporates with less than 500 crore turnover segment has been bearing results, growing at 14% quarter-on-quarter. Growth across large and mid corporates was 3% quarter-on-quarter and 19% year-on-year, in line with our expectations. Majority of the corporate loan book is floating rate in nature, and we were able to pass on increased rates for the customer due to reset. Our yield in the corporate book thus improved by 10 basis points quarter-on-quarter. Yield increase hereon will be muted, with benchmark yields stabilizing or coming down. The proportion of A and above rated customers has improved from 73% to 76% year-on-year, and weighted average rating improving to 2.61 from 2.63 year-on-year. The gross slippages in corporate book were only rupees 43 crores for the quarter. Our corporate restructured book too remains low at rupees 327 crores. Over the last couple of years, we consciously changed the guidelines, policies, and coverage model. We have put in place tighter policy norms for complex transactions, rationalized borrower limits linked to internal rating, and much below the regulatory threshold. Conservative capping of sensitive sectors, strengthened post-disbursement checks, and developed early warning systems, etc. Similar coverage models were reoriented with a focus to scale up small businesses and increase wallet share from identified large strategic client groups, thereby improving our risk density and RORWA. Overall, we continue to progress on the granularization of the corporate franchise through small businesses and diversification. Our small business as a percentage is planned to increase from the current 10% to 20% of the corporate book. Within our large and mid corporate verticals, our focus is diversification across regions and more acquisitions, especially in the mid corporate segment. Global diamond and jewelry business. The demand for diamond remained muted, with sluggish growth in key consumer markets of US and China. Our diamond book was up 10% year-on-year, but down 7% quarter-on-quarter, with working capital utilization coming down. The slowdown, however, does not have any impact on asset quality, with number of clients getting into SMA 1 and SMA 2 categories. Overall, we remain comfortable on the diamond portfolio asset quality, while the growth will be dependent on the recovery in the global economy. Other retail assets. We saw another quarter of growth momentum in other retail loan book, growing by 7% quarter-on-quarter and 27% year-on-year. The growth was broad-based across business units. The secured assets, including LAP, business banking, grew 5% quarter-on-quarter, while unsecured assets of credit card and personal loans grew by 10% quarter-on-quarter. The secured asset growth has bounced back as with pickup in the new to bank acquisition, the momentum gathered in quarter 4. We are scaling up our home loan pilot, with the book size growing to 665 crores. We will go full stream with the marketing plan during the course of the year as the pilot stabilizes. Our digital lending platform for small business segment was launched for term loan and non-fund products for Easy Credit last quarter. With this, we have a full inclusive asset suite on digital platform for less than 2 crore segment. The stack is fully enabled to process sanction with a single day, backed by Beru, banking and GST backed data for the small business customers. On unsecured side, the credit growth were driven by new card acquisition and highest ever quarterly spend. Credit card spends were at 20,189 crores, growing by 20% year-on-year. Overall, the focus on branch sourcing and digitization of small ticket acquisition, we expect growth momentum in retail business to continue in the current financial year. We do, however, remain watchful of inflationary economic conditions, particularly on the unsecured consumption spends. Now coming to liabilities. Our deposit grew 15% year-on-year and 3% quarter-on-quarter. The growth was driven by granular acquisition, with retail deposits as per LCR growing by 21%. The share of retail deposit improved to 43.4% as we progress towards our ambition of 45 to 50% by PC6. Our savings account deposits too showed a reverse growth of 6% quarter-on-quarter, reversing the attrition seen in the last 3 quarters. Current accounts moderated as some of the quarter-end flows of the previous quarter ran off. Overall, CASA was stable at quarter-on-quarter at 40%. Our affluent segment deposits grew 22% year-on-year to 44,400 crores during the quarter. Affluent AUM was also up to 68,750 crores, showing a growth of 17% year-on-year. Our NR deposit grew 39% year-on-year and 9% quarter-on-quarter to 37,200 crores. We continue to gain market share in the non-resident segment with market share above 3% as of latest available data. We have 30 branches launched ready currently and around 27 leases finalized. We will aim to be adding 250 to 300 branches during the course of the year. We reduced borrowings during the quarter by 7% quarter-on-quarter. The borrowings form only 10% of the liabilities and almost all are long-term in nature. We continue to carry healthy liquidity position with LCR at 132% and average surplus liquidity at rupees 44,000 crore for the quarter. Overall, we remain focused and comfortable towards achieving a retailization objective. The liquidity in the system has improved during the year and rates in certain buckets are coming off. We continued investment in physical and digital distribution along with maturity of branches will aid our retailization drive going forward. Digital traction. Bank continued to register strong growth in its mostly active user base on both Indus Mobile and Indus Merchant Solutions, 30% year-on-year and 20% quarter-on-quarter respectively. Mobile transaction volumes for the bank grew 82% year-on-year. On retail and MSME business across products, most of the business is now digital. In some products like saving, wealth, credit card, it's almost completely digital, while in MSME, it is still about 65 to 70% digital. Share of digital unassisted direct-to-client acquisition continues to grow. In card, it is 25%. In liabilities, it is 40%. In personal loan, it is 15% in terms of loans to new-to-bank, non-pre-approved customers with real-time decisioning. Bank continued to focus on optimizing digital platform, marketing, and across products we sell digitally. Customer acquisition costs have come down substantially year-on-year. In loans, it has come down by 60 to 70%. During the quarter, Bank also launched a CBDC app and joined other pilot banks in RBI's initiative on digital currency. Last but not the least, the bank has soft launched Indi, its digital platform open for public access. Indi has seen an installed user base of 50,000 plus and a customer base of 20,000 on the app. We will do a full-scale launch during the quarter. Coming on ESG. We are committed to integrate ESG principles deeply into our business, product, risk and management and operations. We are proud to announce that all our pioneer branches have achieved LEED status certification, showcasing our commitment to environmentally friendly operations. Additionally, we have mandated a leading Big Four consultant to formulate a strategy to make IBL carbon neutral by 2032. We are honored to have been recognized as the best bank in India for ESG by Asia Money for financial year 23. This prestigious award received for the second consecutive year is a testament to our dedication to environment and social responsibility. We extend a heartfelt gratitude to all our partners for this invaluable support in helping us achieve this remarkable milestone. Now coming to the financial performance for the quarter. Net interest income grew by 18% year-on-year and 4% quarter-on-quarter in line with the loan growth. Net interest margin improved to 4.29% versus 4.21% year-on-year and 4.28% quarter-on-quarter. The net interest margin was supported by repricing on the asset side as well as active management of the liability. The cost of fund as well as yield on assets increased by around 40 basis points each during the quarter and resulting in the stable margin quarter-on-quarter. Other income grew by 14% year-on-year and 3% quarter-on-quarter. Core client fees, excluding trading income, grew by 19% year-on-year and 2% quarter-on-quarter. We had positive non-core income of 91 crores during this quarter. Share of retail fee improved to 73% from 70% year-on-year. Our total revenue for the quarter was 7,077 crores with 17% year-on-year growth. Operating expenses grew by 6% quarter-on-quarter with cost to income ratio of 45.9%. The OpEx growth was driven by employee addition, investment in distribution, technology spent for the new platform launches, and preparing for annual appraisal actions. The operating profit for the quarter was at 3,831 crores, growing 12% year-on-year and 2% quarter-on-quarter. The PPOP margins to loans continues to be healthy at 5.5%. Core PPOP growth was at a 14% year-on-year and 1% quarter-on-quarter. On the asset quality and provisioning front, our provisioning for the quarter have reduced to 991 crores and are below 1,000 crore mark for the first time in the last 3 years. The annualized provisions to loans are thus down to 132 basis points now versus 142 basis points for previous quarter and 155 crores for the previous year. As expected, we saw a reduction in gross slippages from microfinance, corporate and other retail segments. The vehicle finance unit saw increases in slippages given quarter one is seasonally weak than quarter four. On the restructured book, the retail slippages were down quarter-on-quarter and there was no corporate slippages. The restructured book was reduced by 475 crore during the quarter from 0.84% to 0.65% quarter-on-quarter, with bulk of the reduction due to upgrades and recovery. The net security receipts have reduced from 51 basis points to 44 basis points. The bank made additional provision of 129 crore towards the SR book during the quarter. Overall, GNPA for the banks were at 1.94 and the net NPA was stable at 0.58. We have maintained provision coverage ratio of 71%. Our contingent provisions, excluding specific provisions, were at 1,700 crores. Total slippages from the restructured book in the last 5 quarters were at 2,324 crores. We have utilized contingent provisions of 1,628 crores during the same period. With this, we expect that the utilization of contingent buffers to be behind us and will aim towards adding into the buffers with support from operating environment. Total loans related provisions are at 2.4% of loans and 121% of GNPA. Our SMA1 and SMA2 were at 4 basis points and 19 basis points respectively. Profit after tax for the quarter were at 2,124 crores, growing 4% quarter-on-quarter and 30% year-on-year. Our CRAR, including profits, remain healthy at 18.4%. Return on assets was at 1.9% and return on equity at 15.24%. Overall, the first quarter of our planning cycle 6 strategy saw progression towards the stated objectives. Loan growth was at 22% against our expected range of 18 to 23%. Seasonally, the first quarter is softer quarter for vehicle and microfinance business, and seasonality should support the loan momentum during the rest of the year. Retailization of liabilities continues with 21% growth in retail deposit as per LCR and healthy 6% quarter-on-quarter growth in SA deposits. The share of retail deposit as per LCR has improved to 43.4% and we aim moving towards 45 to 50% in 56. Asset quality improved in all businesses except for vehicle due to seasonality. The annualized credit costs are down to 132 basis points, inching towards our expected range of 110 to 130 basis points for the year. All key profitability metrics across NIM, PPOP margin, ROA and ROE have maintained healthy position in line with the communicated aspirations. We continue to scale up new initiatives like Affluent, NRI, tractors, merchant acquiring, home loans and digital launches. These provide further growth avenues for the bank. We have thus begun well on the PC6 strategy execution and are committed to the ambition laid down outlined in our strategic plan. With this, we can open for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Nitin Aggarwal from Motilal Oswal. Please go ahead.
Yeah, hi Sumant. Congrats on a good quarter. A few questions from my side. Firstly, we have seen a sharp rise in cost of deposits over the past 1 year. So how are you looking at the deposit repricing over the next few quarters? When will this likely peak out? And if you can also give some color on what has driven this strong SA mobilization. and how sustainable this growth rate is?
So our cost of deposit, I think you should see the peak out in quarter two, and I think what has happened in quarter one is a lot of maturities which are coming in, which are contracted at a lower price, got repriced in the retail side of the book as well as on the wholesale banking side of the book. That's number one. And of course, the renewal process which happened at a higher rate because our rates on the term deposits were higher. So that's the reason, and I think you should start seeing a stabilization or a bit rise in the quarter two, and then a stable phase and a decreasing cost of deposit as we get into quarter four. So we've always said that by quarter four we should see a cost of deposit decline by 10 to 15 basis points, and you should see that. Having said that, I think our savings accounts, I think the growth, we always said that the savings account growth was affected because the bulkiness on our portfolio. And there was one such account where the bulkiness on the portfolio was there. And I think once that bulkiness in the portfolio, the acquisition ramp up as well as has helped us grow the savings account. And I think what we have seen in the last 3 quarters is the bulkiness of the portfolio removing, and I think the growth has come back. Even if you look at the LCR growth, you would see that the LCR growth is about 7,800 to 8,000 crores as a consequence of that.
Right. And if I look at slide 20, we have 10 odd basis point increase in the wholesale banking yield and another 8 basis point in the consumer banking, but our total yields has gone up by 22 basis points. So what am I missing here?
That is because of the mix change is more in favor of retail. Quarter 4, if you remember, there was microfinance strong disbursements. So during the course of this quarter, averages were higher for retail compared to last quarter.
Okay, that explains it. Okay, sure. And one more question on the cost income ratio. This ratio has been increasing over the past few years. We are now close to 45, 46 now. So how should we look at this as you go on to add more branches and invest in the business? Where are you looking to?
I've said that this year we will end the year at 45% cost to income ratio, and that is what we said, going up to 41 to 43% in year 2 and stabilizing at about 40 to 41% in year 3. That's what we will be. So I think don't look at this. I think while we may go at the end of the year, you will see us stabilizing at 45% and will come back to 41 to 43% by year 2. We have some initiatives, and of course the salary, so this quarter has the salary appraisal part also, so that will all stabilize.
Right. And one clarification, like have you got any RBI circular in respect to overdue ECLGS loans in the MFI segment? Any impact that you have seen from that?
We don't have a significant book there which impacts us.
Okay, but did you see some downgrades because of that circular this quarter?
No, we don't have any significant impact because of that. The numbers reflect all the circulars that are out there.
Right. And lastly, if I can squeeze in one more question, any thoughts on the promoter shareholding plans? Because this has been in the news for some time, and so where is the application really with the RBI? What stage it is, and any color as to what are the promoter plans in terms of increasing stake? If you can give some color on this.
The promoter has issued a press release, and we can only talk what is in the public domain, that they want to increase the stake. Now, as and when the bank does not need the capital as of now. We also know that the process is still continuing, and there is no approval from RBI on the Form A as of now. So we have to wait for the formal communication of the Form A, which is the due diligence from RBI, and that's a process which takes 3 months. Almost 2 months are over, and I think that we have to wait for that announcement from the RBI or from the promoter.
Right, sure. Thanks, Sumant. Thanks so much, and wish you all the best.
Thank you. Next question is from the line of Adarsh from CLSA. Please go ahead.
Hi, Sumant. Congrats on good numbers. Couple of questions. One on the cost of funds. Just wanted to understand.
Adarsh, sorry to interrupt you. You're sounding a little distant. May I request you to speak a little louder?
Yeah, so hopefully this is better. On the cost of funds, Sumant, just wanted to understand from a deposit maturity and a renewal perspective, where are we in that journey? Like, is it 50%? And broadly, any sense that would help, because you said maybe 1 more quarter of cost of fund increase. So where are we in that journey?
So I I think you would see that the yield curve between 90 to 1 year is almost flat, and it has come down. It's from 7. What happened in March was madness, and we had to raise some borrowings also as a consequence of the effect which was happening in the U.S. market, in the liquidity market. We raised cost of borrowings at a little bit higher cost, and that impact you are seeing happening. I think with the deposits now, bulk deposit rate stabilizing and our retail journey growing, I think over a period of time, I think maybe this quarter, I think you should start seeing the stability in the cost of deposit as we go forward into the years in the quarter 3 and quarter 4. So you should start seeing that, and I've said that you should start seeing a 10 to 15 basis point decline in our cost of deposits as we go forward.
And if I use that data with the fact that our loan mix is improving, it then looks like our margin guidance is kind of conservative, right? We are already at the higher end. And if it's a quarter more of cost of fund increase with improving loan mix, is there any upside risk to the margins, or what are we missing here?
No, others have always said our margins will be between 4.2 to 4.3. Don't forget we have a book which is 45% corporate, 44 to 45% corporate book. On this book, you would see a margin suppression as because the MCLR or the EBLR will continue to change as we go forward. If they don't, I think you will start seeing the margin expansion. Otherwise, you will see what we said, 4.2 to 4.3. We are assuming that there will be a decline in the corporate yields as we move forward into quarter 3 and quarter 4. But yes, but those will more or less be substituted by the gains which we will get in the cost of deposits. So, in our opinion, I think our margins, and if you look at 6 quarters in the presentation in the investor, we've been very stable and will continue to be stable in our margins.
Got it. And my second question is on capital consumption. Your risk weight, assets have come down in the quarter with a decent balance sheet growth. So if you can explain that, and your credit risk weight to loans are probably lowest I've seen for many years. So.
Yeah, so a couple of key reasons for that. One is some of the unrated portfolio got rated during the quarter, so that released some of the risk weights. And we also had some of the non-utilized limits getting reduced quarter on quarter, both for funded as well as non-funded, which caused some of the release in the RWA.
And we're done with that process?
Unutilized limits, they vary depending on the customer preferences, but rating unrated to rated, I think that's behind us to a large extent.
Perfect. Congrats again and thanks. That's it.
Thank you. Next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, Thomas. Congratulations for the set of numbers. Firstly, on the slippages and the credit cost is still at the upper end of the guidance. And when we look at it, in fact, we have utilized 200 crores of contingency buffer as well. And you highlighted earlier that maybe we are largely done with the utilization and we will try to create further buffer as well. So how confident we would be with respect to the credit cost trajectory of 1.1 to 1.3 odd%? And even on the slippages side, it seems to be relatively high, maybe you mentioned because of seasonality in 1Q. But maybe if you can just highlight in terms of how much was vehicle and MFI within the same.
So first of all, I think I'm very comfortable with the 110 to 130 basis point, including the contingent reserve of 400 to 500. We will do that this year, and we will add to the contingent reserves. We've said that, and we will make sure that we do that. So that's number one. And we are very comfortable with our numbers, and I think with the recoveries focus which we put on the MFI, we believe that we will be able to manage that. Having said that, the second question on yours was on the
slippages from vehicle increased from 383 crores to 581 crores. We will upload as usual the segment-wise slippages in our opening remarks when we upload on the website, so you'll get the segment-wise slippages.
Okay. And MFI would be, sorry, if you can just highlight that number as well. So.
MFI has come down from 599 crores to 369 crores.
Okay. So 370 crores of MFI and 580 crores of vehicle.
Correct.
Okay. Yeah. And secondly, in terms of say the overall OPEX, so not much of addition to the branches which we are expecting. But still, so is it maybe whatever has been the rise primarily because of the annual incentives bunched up in 1Q, or maybe we see now that employee cost regularly would be at the current level?
So the employee cost will be elevated. Some of it is fixed, but I also believe that we've expanded our distribution specifically in the microfinance segment, where we've had if you look at the cost, 65 to 70 crores of that cost has come from the microfinance segment, because we are expanding our distribution in the microfinance to get the business done in a bigger way and get new to client customers. And I think on the vehicle finance side also, there's a 30 crore cost increase which has happened because of the other thing is the full cost of the new branches have now got absorbed into the quarter, and that has also come in. You remember in quarter 4 we had a huge expansion of branches. That cost has fully got absorbed because it would have come for 30 days or 45. This has come for the full 90 days. So that cost has also come into this quarter.
Okay. And no branch addition this quarter, but still quite a rise of almost like 7% in the overhead cost. So what would have led to that?
No, so I have told you, I think there is an increase in number of employees. There is an increase in the digital capabilities and the cost which we are incurring of that. Microfinance expansion which we are doing. I think our cost on the retail assets which we have grown, I think at a faster pace, that cost is coming in, and of course the CFD cost where I think we are expanding our businesses into new domains like affordable housing and two wheelers, where I think we're seeing some cost coming in. So I think that's a matter of time that you will start seeing stability of that cost coming in. And I think, like I've said, I think you will see a 45 to 46% cost in quarter 1, quarter 2, stabilizing to 45% as we end the year. And you should see next year a 41 to 43% cost to income ratio.
Okay. And lastly, in terms of MFI, so still, I think in terms of the sales compared to where the competitors are, in fact, our growth rates are relatively slow. Maybe last time also you highlighted, but when do we see, maybe we were expecting some kind of a sequential momentum in this quarter, and you highlighted that maybe the MFI will be one of the growth drivers. So when do we see that change in trend in terms of sequential momentum catching up with the peers, given that investments is also being done in this franchise? Yeah.
So we've said the overall micro banking book will grow at 28 to 30%, but within that, microfinance will grow at 18 to 20%. We are at 14% year on year. I think you will see an 18 to 20% growth. That should start coming in the second quarter itself. And I think what you will see is the other businesses growing at a very fast pace, and you will start seeing that growth also. So in quarter 2, I think quarter 1 is relatively a weaker quarter in the microfinance segment, and I think it's the second half of the year where the growth actually comes in. But you will see that in quarter 2 itself, that our growth will be there in the microfinance segment. And I think in quarter 1, I think we have implemented a new technology. We wanted to make sure that our collections were reduced, flows reduced, and I think that's what we wanted to get into. And I think the momentum is now back, and I think we're already seeing in the first 15 days of the month very good momentum in the disbursements in the microfinance segment.
Oh, okay. Okay. Yeah. Thanks and all the best. Yeah.
Thank you. Next question is from the line of Abhishek from HSBC. Please go ahead.
Yeah, hi, good evening, Sumant and team, and congratulations for the quarter. So most of my questions are answered. Maybe I just need a couple of data points. If you can share the weighted average cost of term deposits and SA, I think that will be great. Thanks.
We don't give those numbers, and I think we've never disclosed that numbers ever.
Sure. Okay. Thanks then, and all the best for the following quarters.
Thank you.
Thank you.
The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, sir. Just one question. So your credit cost guidance this year would factor in any additional provision for the security receipt, contingent build-out, and the net slippage, right? So that 110, 130 includes all the three, right?
So you're asking me a question or a confirmation? So we actually believe that all these costs are loaded into 110 to 130 basis points.
Okay. And just in terms of if you were to move to this ECL now, how much do you think you would need as a buffer?
So our contingent provisioning is what we are doing to make sure that we are ready for ECL.
Yeah, but how much would you kind of need?
The attributes are still not finalized by the Reserve Bank of India. So I think it's very difficult. We said that our ECL will be in the range of 1.5%, 1 to 1.2% of the book. And I think that's what we are working on. It has to be amortized over 5 years. We don't want to wait for it. And that's what we are working on.
Oh, got it. Thank you.
Thank you. Next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi Sumant. Congratulations on a good quarter. My question is, sir, on loan growth, right? So we have delivered 22% YOY growth, and it is fairly broad-based in terms of large corporate, mid and small corporate, and then retail, within retail, vehicle, and everything. Every major segment seems to be growing at 21-22%. And the question is, do you see within your broad 18 to 23% guidance the divergence of retail growing at a faster pace, or when do we see retail growing at a faster pace versus corporate?
So if you look at the retail growth, microfinance has degrown for me. And I think if you add the microfinance growth, I think the percentage shift would have happened to 55 to 56%. That's where I think, and you will start seeing that growth happening over this next 2 to 3 quarters. And I think by the end of this year, we should end at 55 to 56% in favor of retail and 44 to 45% in favor of corporate bank. We've always said that we want to continue to maintain a very balanced view on our retail and corporate mix, and I think that's the way. I think the corporate will be in the range of 43 to 45%, and retail will be in the range of 55 to 57%.
Sure, sir. And you had mentioned the security receipts in basis point, and then you had provided some 129 crores this quarter. Just to confirm in absolute number that security receipts net of provisioning would be around, what would be that number in rupees crore?
1333.
Sure.
1300 crores roughly.
Sure. Yeah, that is it all. That is it. Thank you, sir.
Thank you. Next question is from the line of Param Subramanian from Nomura. Please go ahead.
Yeah. Hi. Thanks for taking my question. My question is again on the numbers given on slide 21. So if you look at the segmental yields, across corporate and consumer banking, it's up 8 to 10 basis points. So I think you mentioned, the increase in yield quarter on quarter of 20 basis points is being driven by mix. But even, the mix seems to be stable quarter on quarter between corporate and consumer. So could you help us out with what we're missing over there? Yeah.
No, you are looking at the period end numbers. So like we explained earlier, last quarter microfinance disbursements were quite strong and they happened during the course of the quarter. So if you take the daily average mix, this quarter is much better in terms of the retail portfolio, and that too particularly microfinance, which is the highest yielding segment. So that is causing the yield moving the way it has been disclosed.
Okay.
Whatever we disbursed in microfinance last quarter was available full quarter in this quarter.
Okay, got that. Okay, and my next question, again, Sumant, you highlighted that in the opening comments, but on the diamonds, on the gems portfolio, so it has seen some decline. So if you could, give us some outlook on how, business is shaping up over there, both in terms of growth and asset quality as well. Yeah, that's it from me. Thank you.
So the growth is dependent on how the markets revive. We are in the working capital business, and we do a side business. So I think we have to wait and watch for the markets to revive, and I think it's the second half of the year is when you will see the revival, and we should grow this business at 10 to 12%. That's what the growth on the business is. On SMAs or on, we have no SMAs 1 and 2 in this business at all, and the portfolio looks pristine as of now.
Okay, thank you so much and all the best. Thank you.
Yeah.
Thank you. Next question is from the line of Manish Shukla from Axis Capital. Please go ahead.
Yeah, good evening and thank you for the opportunity. Can you quantify the size of the non-MFI microbanking book once again, please?
That's the merchant acquiring book that we disclose in the loan mix.
It's about 4,222 crores.
Okay, thanks. On the affordable housing piece, right? So how has been your experience so far, and how do you think this book scales up from where we are right now?
So we've changed the team. I think we've not grown that book over the last 2 years. It's 1,700 to 1,800 crores. The experience cannot be in such a small book. You cannot define an experience. I think we've started scaling up the book now. We've got a team in place, and I think we see that this book will touch about 5,000 to 5,500 crores in 3 years, and that's what our ambition is. 15,000 crores of mortgages and 5,000 crores to 5,500 crores of affordable housing.
So, okay, 15,000 crores of mortgages. And this mortgages is, I'm assuming you don't include LAP in it, it's your own loan.
No. I told you we've got into housing loan segment. We are doing a pilot right now. We have a 665 crores. By the end of this year, we should be around a 4,000 to 5,000 crore book, and then we will start scaling up the book.
Sure. Those are my questions. Thank you.
Thank you. The next question is from the line of Sumit Rathi from Centrum PMS. Please go ahead.
Thank you for the opportunity and congratulations on the good set of numbers, sir. I just wanted to check our NPAs in the consumer financing book across the product has gone, GNPA numbers have gone slightly up Q on Q. How can we see it going forward, and what could it have an impact on our credit cost prospects of 1.1 to 1.3%?
So I think if you look at the consumer finance book, non-microfinance is about 14 to 15% of our book. If you look at the numbers which are coming on that, I think we had a 280 crores of flow which happened on that business, and I think the recovery rates are also very high on that business. So I think while I think the credit card is the largest flow element in that business, I think with the credit card is 3% of our book. So I think we should be able to maintain our credit cost. So when we've done we've given our calculations of 110 to 130 basis points, we said 44 to 45% of our book will be corporate, which will become at 20 to 20 basis points of credit cost. I think for the consumer bank will be around 150 to 180 basis points of credit cost. If you look at microfinance, will be 250 basis points of credit cost, and our vehicle finance business will be at 100 basis points of credit cost. You compute it will come to 120 to 150 to 120 basis points of credit cost.
All right, sir. On the corporate finance book, can you dwell a bit on what is the? You said you have some early warning systems over there. So what are these early warning systems, and what is the top 10 or top 20 big accounts we have? Like what percentage of our book? If you can dwell on that, sir.
So the top 20 accounts on the large corporate side, which we don't disclose, is a very small percentage left of our book, very high, but it has now reduced sharply on our book, and I think it's about 12 to 13% of our overall corporate book now. Having said that, I think on early warning indicators, I don't know how to explain it to you. There are 200 attributes which we use. Now I can't explain each and every attribute. There are different attributes which we use to identify early warning indicators, and I think we use them very effectively and manage our portfolio. And we don't not even manage our portfolio in the large corporate. We also use it in the MSME and the SME side of the business, or any business owner segment side of our business.
All right, sir. Those were my two questions. Thank you for your time.
Thank you. Next question is from the line of Jignesh Syal from Infred Capital. Please go ahead.
Yeah, hi. And thanks for the opportunity. Just wanted to check on a couple of things. One, we are seeing that, our CD ratio has been inching up sequentially right now.
Sorry to interrupt you. Your voice is not coming clear.
Is it better now?
Yes, sir.
Yeah. So our CD ratio has been inching up, and right now we are somewhere around 86.8. So at what level are we comfortable, or do you think it can still we have enough room to grow it further? What's our comfort level for the CD ratio overall?
Our comfort level on CD ratio is 86 to 89%.
Okay. Understood. Secondly, if we see it up, there has been a sequential jump also that we are seeing it up on the investment book as well. So anything specific that we did into, or it's just generalized and we should see it normalizing over coming quarters, or can you give us some idea on it?
Yeah, sure. So the increase in investment book is primarily due to excess cash being deployed in short-term treasury bills. So we all know that the rate cycle is sort of benign at this point in time. So the idea is that the excess cash that we get, we've got to ensure we get ample returns by way of having a secured portion through government securities, and that can come and help whenever we wish to, if we see a higher credit growth. But having said that, I think there are two or three avenues that you must see. So that's cash and bank balances, the investment book, as well as balances with RBI. So you'll see a proportionate increase or a decrease in some of those, getting a mix or getting a change in mix in that. So it gives me a higher yield of around 30 odd basis points.
Understood. And just lastly, on the corporate banking side, we have been seeing a consistent sequential surge on the small corporate portfolio. Though overall proportion-wise, or the quantum is still pretty smaller compared to large and mid. But can you give us some flavor on what kind of lending is happening out here and all, and how much you are comfortable growing it up further from here on? That's it from my side. Thanks.
Yeah. So our small corporate book, 2.5, 3 years back was around 4% of our total corporate book. Today, as we speak, it's around 10.5%, and the idea is to take it to around 20% in the next 2.5 years of the corporate book.
Understood. Perfect. Thanks. But just one add-on to it. Will the yields would be relatively better off compared to mid and large corporate? Will that be a fair understanding?
Yeah. Yields are better, and obviously the granularity is it's much more diversified in terms of the ticket size and stuff like that.
And this is secured.
And these are secured, yeah. These are all secured.
Perfect. Sounds great. Thanks a lot, and all the best, sir.
Thank you very much. I now hand the conference over to Mr. Sumant Kathpalia for closing comments.
Thank you for participating in the call. As usual, me and Indrajit are available for any further questions which you may have. Thank you, and God bless.
Thank you very much. On behalf of IndusInd Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.